Hi traders, good morning and welcome to my YouTube channel. And from this week, I am planning to start a new series of educational videos on my YouTube channel. Yes, I have been making educational video on my YouTube channel for a long time. But I am starting with a new kind of series where I am planning to make it more interesting using more of graphics, more of images, more of text in the video so that it is more engaging for my followers. And this series of video will not be very long video. It will be small videos, very crisp videos where within a small duration of time you'll get lot of knowledge. So that is the new initiative I'm taking from this video. So as a part of initiative, first video today I'm going to post is 7 lessons I learned being in the market for last 20 years. As per the estimation, around 89% of traders they lose money in trading. And another fact is almost 80% of traders they leave stock market after 2 years being in the market. And the harsh reality is trading is not easy. And that is what the objective of this video. If you stay in this video for a few minutes, I'm going to discuss 7 important lessons which I learned being in the stock market for last 20 years. And the first lesson is overbought and oversold indicators are not reliable on the long term. For example, indicators like RSI, indicators like stochastic, they normally give the signals on overbought and oversold. That means as per RSI, they say that whenever it is above 70, that means it's a overbought zone where you can take a short position. And when RSI is below 30, that means it's a oversold zone and where you can take a buy position. But it can backfire sometime. For example, look at this chart. This is the chart of 5th April. And look at this Nifty chart. It opened here and look at where is RSI. And you can see that RSI is above 70. 70 is here. And you can see that almost till 10:30 it was above 70 only. And if you kept on shorting here, thinking that it's above RSI, above 70 RSI, then you would have kept losing the money. And you can see that after that it started coming below RSI 70, but it was hovering around RSI 60. That means as per RSI, it is still overbought zone, but you can see that again it went above 70. Again you started shorting, but again you started losing money. And you can see that from 9:15 till 3:30, you can see that RSI was almost near around 60. And throughout the days, it was at the overbought zone, but it never came down, right? So that is the one of the big problem with all this indicator, which gives you overbought and oversold signals. So that is the wrong approach. Trading based on overbought and oversold is the long approach because market can keep going higher and higher and higher, and market can keep going lower and lower and lower. So this is the first lesson which I did the mistake when I was new to trading around 20 years back, where I was relying more on this kind of overbought, oversold indicators like RSI, stochastic and all this. Most of the videos which they discuss on this kind of indicators. So that is the mistake I have done in the beginning of my career. And that is the first lesson, that overbought and oversold indicators are not reliable in trading. Okay, next lesson is 20 EMA is the only indicator I needed on chart. And let me ask you something. Tell me whether it also happened with you. Like you started with many indicators on the chart, and when you have seen that you are not able to make profits with that indicators, you removed those indicators and you started with some other indicators to see whether it is working. When that indicator is also not working, then you removed all those indicators and you tried with something else. Tell me whether it happened with you. Yes, it must have happened with many people because it also happened with me. When I was new to trading, I was using many indicators and I kept on changing the indicator after indicator, and finally I settled for 20 EMA. So don't overload your charts with so many indicators. You need only 20 EMA on your chart. 20 EMA is something which can act as a strong dynamic support and resistance, and also it can act as a accurate entry point most of the time, especially when trend is very strong. Look at this chart. In this chart, you can see that how nicely whenever it came near the 20 EMA, it took the support and again it started the trend on the upside. So 20 EMA is one of the very powerful indicators for traders. Now the question is, why 20 EMA works so well on the charts? Because it is believed that most of the big players, most of the big institutes, most of the FIIs, most of these big players, they follow 20 MA on the chart, and that is where most of the time they take that trading decision about going long or short. So that is the reason it is believed that 20 MA is one of the most powerful indicator on the chart. Okay, now the lesson 3. Supply demand support resistance. That is what works in the market most of the time. So that means focus more on supply demand, more on support resistance. When I was a new trader, I lost lot of money focusing too much on the indicators, ignoring the support resistance, supply demand and all this. Look at this Bank Nifty chart. This is where Bank Nifty took the support. And what is the reason Bank Nifty exactly took the support? Is it because of any indicators? No, it is not because of any indicators. It is because of the support at that level. Look at the first candle low. That was the strong support. That is the same place where Bank Nifty took the support. Look at this level. This is where Bank Nifty again started reversing and started making a red candle. And it is not because of any indicators. It is because there was a strong resistance. Resistance is nothing but supply zone. Supply zone is nothing but there are sellers are present. So that is why market reversed. Demand is nothing but support. Support is nothing but buyers are there at that level. So that is what trading works based on the logic of buyers and sellers. And that is what works on supply, demand, support and resistance. Focus more on that. Okay, and the third lesson is paper trading is good, but don't take it as a granted of your success. So when you are doing the paper trading, you are eliminating one of the biggest part of trading, that is the trading psychology. Trading psychology plays very important role when it comes to trading. So when you are doing the paper trading, then there is no real money involved. So psychological pressure of real money is not there. So that's why you'll see the difference when you do the paper trading and when you do the real trading. Your result might differ considerably in real trading compared to your paper trading. So that is what I have done the mistake when I was a new trader. I was doing paper trading for few days and I seen the good result in paper trading, and immediately I started with a big capital and I lost all my money when I started with the real. Don't jump into the real trading after paper trading with a big capital. Start with a small capital with a small lot size. Because you have seen success as a paper trader, now you think that you will be successful as a real trader. No, it may not happen immediately because the psychology is different in paper trading and real trading. Yes, I am a big fan of paper trading. I also suggest my all students after the webinar to start with paper trading. But after the paper trading, don't start with a big capital thinking that you are successful with paper trading. After success with paper trading, start with a small size, the small lot size with the real money, and then only you can think about increasing the size once you see the consistency. Okay, now the next lesson is losing money is good in trading. Now it may sound odd for many people, but as I said earlier, trading is not easy. You should treat trading as a learning experience. When you lose the money, you learn more from the losers than from the winning trades. When you make a losing trade, then you will learn more from what you learn from a winning trade. So learn from that bad experience, from that mistake, and don't repeat it. In normal life, we are not comfortable taking the losses. When we take the losses, we feel ourselves as a losers. Feeling is not good when you lose a trade. When I was a new trader, I used to feel like whenever I lost a trade, I felt like a loser. I felt that it's a slap on my face. But over the period of time only, I realized that in trading, losing is good because it will teach you many things. And when you are trading, you have to detach yourself with the money. You can't be too much attached with the money. Trading makes one of the difficult profession to master because you have to think differently, but ensure that your losses are never big. Ensure that your losses are always within 1% of your capital. And the next lesson is focus on preserving your capital. Let me tell you my experience. I have seen improvement in my trading after focusing more on my risk rather than focusing on profit. Professionals focus on how much money they lose before how much money they make. So you should think like that. And the key to making money in trading is simply to stay in the game. And how you can do that? By preserving your capital. you can stay in the game for longer term, and more you stay here, more you will learn. First, remember, to become a successful trader or a profitable trader, first you need to become a break-even trader. So first think about becoming a break-even trader, then only you can think about becoming a profitable trader. So to become a break-even trader, first thing you need to preserve your capital. So focus on that. And now the last and the seventh lesson is trade a strategy that fits your personality. When I was a new trader, I was following one of the successful option trader in social media platform. And that option trader was more into option hedging. He was more into option adjustment and all this. He was a non-directional based trader. So since I was following him, I also thought that I will also trade like him. And I also tried to become a non-directional trader. And I lost a lot of money. Even though whatever I was doing, everything was backfiring and it was not working for me. It must have worked for him, but it was not working for me because that was not fitting my personality. That option adjustment, taking a non-directional based trades were not suiting my personality. And after becoming from a non-directional to directional trader, I seen that there is a change in my trading performance. So that is why some people non-directional might work, some people directional strategy might work. So first understand your trading style, which works better, then focus on which time frame works best for you. Some people maybe 1 minute time frame works better. Some people maybe 5 minutes time frame works better. Some people maybe 15 minutes time frame works better. Some people maybe 1 hour time frame works better. That you have to ask yourself. Suppose you are a trader who likes fast pacing, then 1 minute suitable for you. Then maybe you can think about scalping in Nifty Bank Nifty. If you think that 1 minute doesn't suit you, if you think that it is 5 minutes which suits you better, then you can go for day trading. If you think that for you higher time frame like 15 minutes, 30 minutes or 1 hour, then you should think about swing trading more than day trading. So that is what you have to trade as per your trading personality. And you can see that recently I have launched new course, that is the scalping course, 1 minute scalping strategy in Nifty Bank Nifty. But along with that, I also have a course called 25 day trading strategies in Nifty Bank Nifty. I have both the course, both are for day trading, but scalping course is on 1 minute time frame, day trading course on 5 minutes time frame. So you have to ask yourself which suits your trading style, whether scalping or day trading. So that's about this video about these 7 lessons which I learned from last 20 years. So let me know in the comment section, how did you find this new initiative? So that's it guys. I'll see you soon with a new video. Until then, bye and take care.